You did everything right. You worked 40 years, saved diligently, retired comfortably. Then you open a letter from Medicare, and your premium just jumped by nearly $5,000 a year because of a house you sold 2 years ago. This isn't a mistake. It's a hidden surcharge called IRMAA, and it punishes retirees for a single good year. Let me show you exactly how it works and how to fight it. It's called IRMAA. 5 million retirees pay it. The reason? A law that looks back 2 years, punishing you today for a home sale or Roth conversion you already forgot. Good planning turns into a premium spike, but you can fight it if you know how. Here is how the trap works. When you sign up for Medicare, you expect a fixed premium. Most retirees pay a standard $185 a month for Part B. But if your income crosses a certain line, Social Security tacks on a surcharge they call IRMAA, the income-related monthly adjustment amount. That surcharge can push your Part B premium up to $672 per month, and it's based on your tax return from 2 years ago. Not last year, not today, 2 years back. So, an event you already moved on from, a property sale, a Roth conversion, an inherited IRA distribution, comes back like a ghost and jacks up your Medicare bill in retirement. Meet David. He's 66, worked as a contractor his whole life. 2 years ago, at 64, he sold a small rental property he'd owned for decades. He walked away with a one-time capital gain of $110,000. He did everything else right. No debt, a paid-off house, a nice little nest egg. Then last month, a letter from Social Security arrives. His monthly Medicare premium just jumped by $450. He thought it was a mistake. It wasn't. Here is the brutal math. For a married couple filing jointly in 2026, the first trigger point is $218,000 in modified adjusted gross income. Below that, you pay the standard premium, $1 over that line, and you move into the first surcharge bracket. That one single dollar will cost you an extra $1,052.40 per person per year. If both spouses are on Medicare, that $1 costs over $2,000 annually, and the brackets are cliffs. $1 more, you pay the entire surcharge for that tier. No phase out, no sliding scale, just a cliff. David's rental sale pushed his income to $230,000 that year. That landed him in the second tier, and because of the 2-year look back, he's paying for that sale now. Not the year he had the money, but here is the twist he didn't see coming, and most retirees miss. That same look-back law also has a secret exit, a form called the SSA 44 that can wipe out those surcharges if you know which life-changing events qualify and how to present your case. David tried to appeal. He called Medicare. They told him one-time capital gains don't count. They were technically right, but they didn't tell him the full story. In Act 2, I am going to walk you through the exact bracket thresholds that hit retirees hardest, the common moves that trigger them without warning, and the hidden loophole inside the appeal process that even some Social Security reps don't mention. That loophole could save you nearly $7,000 a year. Let's unpack the exact numbers, because the cliffs are brutal. For 2026, if you are single and your modified adjusted gross income exceeds $109,000, you enter the first surcharge tier. Married filing jointly? That trigger sits at $218,000. And these aren't gradual tax brackets where you pay a little more, only on the dollars above the line. Cross by a single dollar, and you owe the full monthly surcharge for that entire tier. No proration, no mercy. The first tier adds $81.20 to your Part B premium and $14.50 onto Part D. That's an extra $1,148 per person per year. The second tier jumps to $203 monthly for Part B alone, which means a couple can face over $4,800 a year in extra premiums. The top tier for those with income above $497,000 if single, or $994,000 jointly, adds $487 a month just for Part B and $91 for Part D. That's nearly $7,000 a year per person. And remember, this number is based on income from 2 years ago. The sale, the conversion, the withdrawal, it already happened. The money might already be spent on a roof repair or a grandchild's tuition, but the bill lands in your mailbox now. Take a real case. A couple from Ohio, both 68, with a $1.9 million nest egg. 2 years ago, they sold a chunk of tech stock to pay for a kitchen renovation. That sale generated a long-term capital gain, pushing their joint income to $340,000. That landed them in Tier 2. Their Medicare premiums this year, an extra $400 a month combined, nearly $4,800 more for a renovation they'd already forgotten about. The wife told a reporter it felt like being punished for being responsible. That's the emotional core of IRMAA. It feels like a penalty for doing what you thought was smart. And it's not just asset sales that trip the wire. A man in Florida did a Roth conversion planning to minimize future taxes. He converted $95,000 from his traditional IRA. That conversion counted as taxable income. It pushed his Magi just $3,000 over the next bracket threshold. That $3,000 miscalculation triggered an additional $4,752 in Medicare premiums, a 158% tax rate on that excess income. Another retiree received an inherited IRA from his mother and took a required minimum distribution of $42,000. He didn't realize that distribution counts as income for IRMAA, even though the money went straight into a savings account. That single distribution bumped him 2 tiers, costing him an extra $320 every month. The stealthiest trigger, however, is something that feels tax-free in every other context: municipal bond interest. City and state bonds generate income that's exempt from federal income tax, but IRMAA's definition of modified adjusted gross income adds that interest right back in. So a retiree thinking they're being clever with a heavy muni bond portfolio can slide right into a surcharge bracket without any warning signs on their tax return. Now, here is where the story turns. All of this can be reversed. There's a form buried on the Social Security website, SSA 44. It's called the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form. If you've had one of 8 qualifying events, marriage, divorce, death of a spouse, work stoppage, work reduction, loss of income-producing property, loss of pension income, or an employer settlement, you can petition Social Security to use your current year's estimated income instead of the stale 2-year-old number. They effectively hit reset, basing your premium on what you are earning now, not what you earned during that one-time spike. David, our contractor with the rental property sale, got this right. He retired fully at 65, a full year after his big capital gain. He filed the SSA 44, citing work stoppage as his life-changing event, and provided a letter from his accountant projecting his current year income at $54,000. Social Security approved the appeal in 6 weeks. The $450 monthly surcharge vanished. He's paying the standard premium again. He saved over $5,000 this year alone. His mistake was thinking the system was inflexible. The truth is, the system has a pressure valve, but you have to know when and how to turn it. The catch is that the form itself is a minefield. One wrong box checked, one missing supporting document, and your appeal gets rejected without explanation. And there's a particular sequence of moves, a hidden strategy, that not only erases current surcharges, but can lock in lower premiums for future years, even if you take another big gain later. In the next section, I'm going to walk you through the exact step-by-step appeal walkthrough, the most common reason people get denied, and the counterintuitive tactic that lets you legally sidestep the 2-year look-back entirely in some cases. Here is exactly how to use the SSA 44 form to wipe out an IRMAA surcharge. First, download the form from the Social Security website. It is officially called the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form. You will need to list one of 8 qualifying events. Work stoppage is the most powerful and widely applicable for retirees because retiring after a high-income year fits perfectly. You must attach a signed statement from your former employer confirming your last day of work, or a letter from your accountant projecting your current year income. Social Security wants to see that your MAGI will be permanently lower, not just a one-time dip. Once you submit, the timeline is 4 to 8 weeks for processing. If approved, the reduction applies retroactively to January 1st of the current year, meaning you get refunded for any overpayments already made. But here is where most people get denied, and the reason will infuriate you. The form asks for your annual income for the tax year 2 years before the effective year. That is the high year. Many applicants accidentally enter their current lower income there, hoping it will be accepted. It won't. You must report the high year number exactly as it appeared on your tax return. Then, on a separate line, you report your reduced current year income and explain why it dropped. A single mismatch between the high year figure and actual IRS records triggers an automatic rejection. No one calls to clarify. You simply receive a denial letter weeks later. Another denial trap. One-time capital gains do not count as a life-changing event. If you sold a rental and retired the same year, you can use retirement as your qualifying event, but you cannot use the sale itself. You must separate those facts clearly in your explanation letter. If you write, "I sold a property" as your primary reason, you will be denied. Instead, state, "I retired on this date, and my income is now reduced to this amount." The property sale becomes background noise. Now, the counterintuitive strategy. Once you reset your income baseline using the SSA 44, you have a 2-year window. Social Security will look at your actual tax returns again 2 years later. If your income in that future year rises above a trigger threshold, the surcharge returns like clockwork. But here is the secret that financial planners use for high net worth retirees. Instead of spreading a large Roth conversion or capital gain across multiple years and staying permanently above the threshold, bunch all the income into one single year. Yes, it will trigger a massive IRMAA surcharge for that 2-year cycle. But then, you deliberately create a life-changing event in that same year, such as retiring fully or shutting down a consulting business. You immediately file the SSA 44 to reset your income to a low baseline. Once approved, your Medicare premium drops to the standard rate, and because you front-loaded all your taxable events, your income for subsequent years stays safely below the brackets. You take the hit once, pay IRMAA for 2 years, and then lock in low premiums permanently. That same smooth, multi-year approach would have kept you in a moderate IRMAA tier for 6 or 8 years, costing far more cumulatively. This is the blow-it-up-once method. It feels counterintuitive because we are trained to avoid big tax years, but IRMAA is not a tax. It is a benefits cliff. A one-time dollar over a bracket costs you more than a dozen dollars spread out. One more thing that gets worse. Medicare counts tax-exempt municipal bond interest. So even if you show no federal taxable income on your return, that muni income gets added back into your MAGI for IRMAA purposes. You could be living on what feels like $100,000 in tax-free muni interest, have zero tax liability, and still be slammed with a $400 monthly Part B surcharge. This catches early retirees completely off guard. With all that in your arsenal, you can not only fight a surprise IRMAA bill, but engineer your income to sidestep it for decades. In Act 3, I am going to give you the exact bracket thresholds to monitor each year, the list of every income type that counts toward MAGI, and a planning calendar that ensures you never overpay Medicare again. Let's lock it in. Here are the 2026 IRMAA brackets, the ones you need to guard against. For single filers, the first surcharge hits at a modified adjusted gross income above $109,000. The next cliff sits at $139,000, then $165,000, then $200,000. Then the top bracket kicks at $500,000. For married filing jointly, the first trigger is $218,000, then $278,000, then $330,000, then $400,000, then $750,000. Every single threshold is a cliff. $1 over, and your Part B premium jumps by hundreds of dollars a month immediately. And what exactly counts toward that Magi figure? Nearly everything. Wages, self-employment income, taxable Social Security, traditional IRA and 401k distributions, Roth conversions, capital gains, pension income, rental profits, annuity payments, and the stealth one, municipal bond interest that never shows up as taxable income on your return. If your only income is $110,000 in muni bond interest, you trigger IRMAA even though you owe zero federal income tax. Write that down. Now, the planning calendar. This is what makes the difference between a $5,000 surprise and a $0 bill. 2 years before the year you turn 65, you are in the window Social Security will scrutinize. So if you plan to enroll in Medicare in 2027, the tax return you file next April for 2025 is the one that matters. Anything you do this calendar year to manage Magi directly changes what Medicare will charge you in 2 years. Sell the rental, convert the IRA, take the inherited distribution. Do it before the window closes, not during. If you are already 63, you need to be looking at every line of your projected income right now. A $500 shift in capital gains can save you thousands. Once you are past 65, use the bunching strategy. Front-load the high-income years. Take the IRMAA hit once, then use the SSA 44 to reset your baseline. After the reset, keep your Magi below the threshold for the next 2 years, and the surcharge stays gone. Some retirees lock themselves into permanent elevated premiums simply because they didn't know a reset was possible. Here is the most infuriating part of this whole system, the final detail nobody tells you. Social Security will send you a letter demanding the higher premium. That letter will be detailed with payment due dates and penalty warnings, but it will never mention that you can appeal. It will never include a copy of the SSA 44. It will never hint that a life-changing event might wipe the surcharge entirely. The burden is entirely on you to discover the form, fill it out correctly, and advocate for yourself. The agency that charges you the money is not required to tell you how to stop paying it, so millions of retirees write checks every month for a penalty they could have erased with a single piece of paper. Now, in the final part of this video, I am going to give you the direct link to the SSA 44, the exact 6-page walkthrough I built, and the 1-page bracket cheat sheet that keeps all these numbers in front of you every year. That guide turns everything I just explained into a repeatable 5-minute annual check. That guide turns everything I just explained into a repeatable 5-minute annual check. But step back and look at what this system really does. IRMAA is a penalty designed to quietly extract extra money from the people who followed the rules, who saved, who invested, who avoided debt. And the 2-year look back makes it invisible until it's too late. Most retirees never see it coming, and even fewer know they can fight it. That knowledge gap is the real retirement risk, not market dips or inflation. It's a surcharge on success that nobody campaigned on and nobody voted for. The question worth sitting with: if a government agency can send you a surprise bill of over $4,000 a year without ever telling you there's an appeal form, what else is hiding in plain sight? So, if this video opened your eyes to one hidden rule, imagine what the rest of the Medicare playbook holds. If this made sense to you, hit like and subscribe so it reaches more retirees before the next premium letter lands. And if you want the exact bracket cheat sheet, the SSA 44 walkthrough, and the appeal template letter in one downloadable kit, check the link in the first pinned comment. It's the best next step you can take right now. Stay sharp.